Silver prices came under intense pressure on Sunday as global commodity markets braced for the annual rebalancing of major commodity indexes, an event expected to unleash billions of dollars in forced futures selling over the coming days. The sharp decline has placed silver at the center of market attention, with traders warning that the scale of selling tied to index adjustments could magnify volatility in an already unsettled precious metals market. In the latest trading session, silver extended losses after dropping nearly 4% the previous day, plunging by as much as 5.5% at its lowest point. The sell-off unfolded as investors positioned ahead of the index rebalance window, a period when passive funds are required to realign their portfolios regardless of price levels, sentiment, or broader economic conditions. Gold, while initially weaker, managed to stabilize later in the session, highlighting the uneven impact of the rebalancing across precious metals. The annual commodity index rebalance is a routine but powerful event. Funds that track benchmarks, such as the Bloomberg Commodities Index, must adjust their holdings to reflect updated weightings set by the index providers. This process forces the buying or selling of futures contracts on a large scale and often takes place over a compressed time frame, increasing the risk of abrupt price swings. This year, AS Rebalance has taken on added significance following last year's explosive rally in precious metals. Gold delivered its strongest annual performance since 1979, while silver surged alongside it, driven by a combination of investment demand, industrial usage, and currency movements. Those gains, however, have left the market more sensitive to technical adjustments, with even routine flows now capable of triggering outsized moves. Market estimates indicate that roughly $6.8 billion worth of silver futures may need to be sold to comply with new index requirements. That figure represents approximately 12% of total open interest on the COMEX silver market, a level that traders say could overwhelm short-term liquidity. By comparison, gold's larger and deeper market structure has helped cushion the impact of similar selling pressures. Passive tracking funds are expected to begin selling precious metals futures starting Thursday, following the established rebalancing schedule. Trading related to the adjustment is typically spread across the 5th through 9th business days of the year after the Bloomberg Commodities Index roll period, which runs from the 6th to the 10th business day. During this window, large, predictable flows enter the market, often amplifying volatility as traders attempt to anticipate or respond to the forced transactions. The pressure on silver has been compounded by notable outflows from silver-backed exchange-traded funds. Earlier in the week, ETFs linked to silver recorded their largest single-day withdrawal since October, signaling a retreat by some investors as prices weakened. These withdrawals have added another layer of selling at a time when futures markets are already bracing for a significant supply from index-driven trades. According to market participants and bank analysts, silver is particularly exposed to this year's rebalance. Citigroup has noted that silver AS, smaller market size and lower liquidity, make it more vulnerable to forced selling than gold. When large volumes of contracts must be sold over a short period, price declines can accelerate rapidly, even in the absence of new fundamental developments. The divergence between silver and gold has become increasingly visible. While silver has absorbed the brunt of the selling pressure, gold has shown greater resilience. After slipping earlier in the session, gold prices stabilized as investors weighed short-term technical forces against longer-term structural support. Central bank demand has remained a key pillar for gold, with continued purchases reported amid ongoing concerns about inflation, fiscal stability, and geopolitical risk. The broader context for precious metals remains complex. Last year, AS rally was fueled not only by central bank buying, but also by strong inflows into bullion-backed ETFs and a sustained weakening of the US dollar. A softer dollar has historically boosted precious metals by making them more attractive to buyers using other currencies, a dynamic that continues to influence market behavior. Despite the current turbulence, similar index-related sell-offs in the past have not necessarily resulted in lasting damage to prices. A December 12th note from J.P. Morgan Chase indicated that gold and silver both experienced index-driven selling during last year's AS rebalance, with limited long-term impact. However, the bank emphasized a critical difference this time. The volume of silver required to be sold is larger than in the previous cycle, raising the stakes for short-term price action. The rebalancing pressure is unfolding against a backdrop of heightened uncertainty over U.S. monetary policy. Traders are now closely focused on upcoming economic data releases, particularly the December employment report, which could shape expectations for the Federal Reserve's next move. Any signs of labor market weakness could reinforce bets on additional interest rate cuts, a scenario that would typically support non-yielding assets such as gold and silver. Interest rate expectations remain a central driver of precious metals prices. Lower rates reduce the opportunity cost of holding assets that do not generate income, while higher rates tend to weigh on demand. As a result, economic data that influences the Fed's policy outlook often triggers sharp moves across metals markets. Silver AES position is further complicated by its dual role as both a precious metal and an industrial input. Demand for silver is closely tied to manufacturing activity, electronics, and renewable energy technologies, including solar power. This makes silver more sensitive than gold to changes in economic growth expectations, adding another source of volatility during periods of uncertainty. The current sell-off has highlighted the powerful role of technical factors in modern markets. Index rebalancing, ETF flows, and algorithmic trading can all drive prices independently of supply and demand fundamentals. For traders, the focus often shifts to timing rather than valuation, with attention centered on when forced selling begins and when it finally subsides. As the rebalancing window approaches, many market participants are choosing to remain cautious. Some traders are reducing exposure or staying on the sidelines until the bulk of index-driven selling has passed, while others are closely monitoring intraday liquidity conditions for signs of stabilization. The coming days are expected to be critical for silver. Once the rebalancing process is complete, attention will turn to whether prices can find support or whether additional selling emerges from broader market forces. Gold's relative stability will also be closely watched, as its performance may influence sentiment across the precious metals complex. Beyond the immediate rebalancing event, the outlook for precious metals continues to be shaped by global economic and geopolitical developments, ongoing conflicts, fiscal pressures in major economies, and uncertainty surrounding long-term monetary policy have sustained interest in safe haven assets, even as short-term volatility intensifies. For now, silver remains at the center of a high-stakes market adjustment. The sharp decline reflects the collision of mechanical selling, investor repositioning, and heightened sensitivity following last year's historic rally. Whether the metal stabilizes or faces further pressure will depend on how smoothly the rebalancing unfolds and how markets respond once the forced trades are absorbed. As trading continues, investors and traders alike will be watching closely, aware that while index rebalancing is a predictable event, its impact can be anything but routine. This is a developing story, and further updates will follow as the market digests the full weight of the adjustment.